All right, I think let's rip into it because I know that it is a lunchtime, and you guys might have other things to do, or maybe you are knocking off early for the long weekend, which would be lovely. But thank you so much for tuning in. There's obviously a lot of noise, there's a lot of chat out there since yesterday around the OCR, and we just wanted to sort of give you an update from our side of what that means, and kind of break that down a bit. So I'm Amber, one of the advisors at My Mortgage, and we've got Adam as well. So I guess just a little bit about us quickly before we get into it is I've been with My Mortgage since 2018, an advisor for a few years now. They all seem to blur into one a little bit, but I have a background in accounting, so I have a sort of an interest in sort of self-employed income particularly, but just really excited to be amongst the change. I think at the moment there's a lot of change in the market and rates, and that's all very exciting. Yeah, Adam, do you want to just give you a quick introduction on who you are?
Yeah, g'day, Adam here. So, yeah, I've been around, I think, since 2020, and yeah, I just really I like helping all sorts of different people. I think first-time buyers, obviously, everyone likes helping, but I kind of also like some more, investment type stuff, investment strategy, and larger portfolios are always fun as well. So, yeah, we're gonna just try and do our best to figure out what this OCR review means and what's going to happen heading forward, hopefully. So this is the rest of our team. We have, what have we got now, Amber? Maybe 16 or 17 of us. And yeah, so 6 advisors supported by a good team of awesome people in the background there that make sure that everything moves nice and efficiently and quickly within our business. And we're really, really lucky to have a team like that so that Amber and I can do stuff like this and look after clients. So that's just some of our team, and always seems to be growing. So yeah, moving on to the fun stuff though, Amber, you can kick it off if you want.
Yeah, cool. So I guess the headline right now, or since yesterday, is the OCR. So if we go right back to the beginning, what is the OCR? The OCR is the official cash rate, and it is set by the Reserve Bank. It is reviewed regularly, so every month to 2 months. There's no major pattern to it, but yesterday we had the announcement that it's increased from 2.25% to 2.5%. So essentially, it's gone up by that amount, and one of the tools that the Reserve Bank have for controlling inflation is this OCR. The OCR it's essentially a wholesale interest rate. So it's the bank's cost to borrow money. So at the end of each day, they kind of balance it up between each other or with the Reserve Bank, and that's the cost that they pay to borrow money. When they pass that on to customers, so the rates that you see online, the rates that you get for your home loan either through us or through the bank, that's the bank's cost to borrow money plus the margin that they add to make money. So the OCR does directly impact interest rates as a whole. And one of the key things that the Reserve Bank is looking at the moment when they are sort of reviewing this OCR is what are they doing to inflation? So right now, the economy is not amazing. It's not thriving, as I'm sure a lot of people do know. So there's a lot of chat, or there's a lot of kind of emphasis on wanting to control, needing to control inflation without creating any unnecessary economic instability. So what that kind of means is, yeah, obviously cost of living is biting a lot of people. And so they don't want to create any more madness or craziness in that space while they are trying to control inflation. So right now we are at probably the peak of where inflation might get to. So from the second quarter of 2026, so kind of, yeah, just the end of that part now, inflation was at 3.9%. So the Reserve Bank's role is sort of between 2 and 4%. So yeah, that's kind of the goal. But Adam, do you want to run through those next couple of things on
Yeah,
from that?
and it's a bit of a weird time because everyone knows. I went to the movies the other day and it was like $160 or something to take, our family of 4 to the movies. And so there's just that type of, inflation that you can see in your day-to-day life, and so it kind of is at odds with the Reserve Bank wanting interest rates to go up, because the view of some economists across some of those banks before the OCR was announced yesterday was that a change to the OCR, like an increase to the OCR, is just going to make that worse, that cost of living. But like Amber says, the main thing that the Reserve Bank needs to focus on is getting that inflation back to that sort of 2% midpoint. So that's the goal, and that's the reason why they've kind of pushed that OCR up. So the RBNZ seems to think that over the next 12 months we're going to return back to that 2% midpoint. And I think if that's what they're expecting, like that's not just going to happen on its own. That's going to require probably a little bit more pain to get that gain. So in the next few reviews, I would probably expect, depending on how inflation numbers go over the next few months, to see some more increases, unfortunately. So yeah, and it'll be interesting to see how that gets, how that affects your fixed rates like heading forward. So that's probably what to expect. Here's a few other things. So Amber, you can kick it off if you want.
Yeah, cool. So, I mean, this is very topical. It continues to be topical even overnight. We've seen movement or Donald Trump doing this or Iran doing this. So the conflicts that we are seeing around the world are impacting our inflation. That's kind of the short of it. So the oil prices is a massive part, and that's got a huge impact on the overall supply chain. So it's not just at the pump when we're filling up our cars that we're seeing that's suppliers for food, for materials, for construction, for everything. So we're going to see those impacts for quite some time, and that's where the inflation is likely to sort of persist or stick around. So whatever happens in those kind of conflicts or any resolution we might see, we're probably not going to see it instantly change and it go back to what it was a few months ago. And I think that also just leans into there are lots of factors outside of our control. As a small nation in New Zealand, yes, there are things that we control in our sort of domestic inflation market, but it's those wider things outside of us that unfortunately do have a bit of an impact, and there can just be a bit of a delay. So, yeah, depending on how those things resolve or what we see, maybe it's actually that it stabilizes, it feels a little bit more under control, and there are tools at the Reserve Bank that we can use to kind of get our inflation back in line a little bit more. But yeah, unfortunately, it's likely we will see some further increases to kind of get to our target inflation. What do those numbers look like, Adam?
Yeah, so they're kind of expecting another couple of increases, obviously, over the next little while. So probably before the end of the year, you'll see an OCR at the 2.75 to 3% type range. So that would obviously be maybe two more increases or possibly three. But yeah, I think like when you look at what the official cash rate is and you look at the margin that the bank kind of needs to make, like you're probably still looking at mid fives in terms of fixed rates. Hard to know exactly. There's obviously other things going on, but in terms of an upward trend for interest rates, like you don't really need to freak out too much, I think would be the message. Like we're not going to see post-COVID interest rate increases like to those, 6.5, sevens, anything too scary like that. We're probably going to end up getting back to where interest rates sit in a normal economic environment anyway, which is sort of seems to be around those fives. So don't freak out. They may go up, but they're not going to go crazy, I don't think. So yeah, this is sort of where rates are sitting at the moment. We haven't had any changes into our inbox since yesterday, which is nice. And it's kind of interesting because like usually when that cash rate changes, we do see fixed rate changes relatively quickly. Does feel a little bit like the banks knew what was coming, priced it in probably, and nothing's really changed. And you got to wonder like what what the bank's strategy is as well in terms of keeping things flowing. Like the banks aren't overly busy at the moment, and so like any type of increase may just put the brakes on that a little bit. So kind of wonder if some of that's at play as well. But this is where rates are sitting at the moment. So you kind of 4.5 to 5.5 across the 1 to 5 year spread. So yeah, still a decent rate, all things considered. So I guess we'll just move into structure strategy because like we don't want to hang around too much on rates and what's happening with the OCR. I think probably the main thing being what the advice that we're providing to people around their own personal situations at the moment is sort of important. And so we'll just chat through a little bit around structure strategy, Amber.
Yeah, cool. So the first thing we've got there is short term versus long term. So when we're looking at those rates from the last sort of slide, there's not a huge amount of difference between, there's 1% from the cheapest rate to the most expensive rate in that whole sort of range of pricing right now. But it can make sense to, and this is the same, it works in with that second one. So short term and long term and splitting your lending out. So if interest rates are rising and you're going, oh no, like what am I going to do? You're freaking out maybe a little bit about any increases. Splitting your lending out can help reduce some of what we call rate shock. So right now, if you fixed today at the 12 months at 4.49%, and then in 12 months time, that rate was maybe sitting at 5.5%, then, and you're like, what do I do? Like that's quite a lot. You can sort of think about splitting your lending into a couple of different portions to minimize what that shock will look like. And that very much depends on sort of how much lending you have. If you've got $1 million loan, it makes a lot more sense to split it into different portions, because if that went up by 1%, that's quite a lot more than if you've got a $100,000 loan and it changes by 1%, you'll probably absorb that change a lot easier. So yeah, we can split your loan. You can split it into as many portions as you want. You could have some fixed for 1 year, 2 years, 3 years, 4 years, 5 years if you wanted to. Generally, that's not our advice. It's more about kind of aligning your structure with when you might be expecting changes to your income, or a good time to review lending. I think having something coming up sometimes every year can be useful for kind of going, where are we at right now? What are our goals this year? Do we want to be focusing on repaying our lending faster? Or maybe you've got a drop in income for a period of time, so you want to make it a little bit more manageable. There's lots of different reasons. So yeah, splitting that lending out can help. And by doing that, you can have some fixed for short term and some for long term. So if you've got potentially some money coming in, you might have a bonus that you're expecting. You've got some gifting from family, or anything that kind of changes your position. Like we've got some extra money that you may want to pay off your lending. Having some for short term probably is still a good option. That's going to allow you to kind of take advantage of what right now are the cheapest interest rates. So those sort of 6, 12, 18-month interest rates are sitting the lowest. So being able to kind of take advantage of that, maybe setting your repayments a bit higher to pay it off a bit quicker, knowing that in 12 months time, if the rate's higher, you're either paying it off or you're happy with what that might look like as an increase. So for a lot of people, that's kind of a small portion of their lending. They're likely not setting everything for the short term. Or if you were like, actually, we're going to be selling in 12 months time, you want to align your structure with your goals. And then in the long-term aspect of it, if you are not expecting any changes and you're like, we really want some certainty, maybe it's an investment property. That's something we quite commonly see. Or you're just like, actually, maybe we're going to have a change in income. It's going to drop. We need to know what those repayments are going to look like, because we don't want to be shocked when the rates go up. So yeah, having a good chunk of your lending in that long term, and that might not necessarily be 4 or 5 years. It might be that 3 years as actually the right option for you, and kind of finding a midpoint in what that rate is and what that value is likely to bring to you. So yeah, there's lots of ways we can structure that loan to make it work for you. And those are a couple of the good things. If you do have extra money, Adam, what can you do with that?
Yeah, well, I guess for those coming to us at the moment, like offset and revolving credits are becoming more common. So it's been probably for quite a long time one of the best kept bank secrets was offset and revolving facilities, I think. But with people getting a little bit more savvy and more information being available, it seems like people are more aware of offset and revolving facilities and how to use those to their advantage. So a few situations where these kind of work quite well might be if you've got some money lying around, if if you receive an inheritance or you're expecting an inheritance or you're expecting to come into some money, then sometimes offset and revolving facilities can be a good way of sort of structuring your borrowing to take advantage of those funds that you've got in your account while they're sitting against your home loan and you're not paying interest on that portion, or you're paying your loan down quicker because it's offset against that money. So the other situation is where people are selling and buying. So sometimes when you sell and then go and buy again, you may have more money sort of available in sale proceeds hanging around once you've sold than what you need to contribute to buy the house. And sometimes people want to hold on to those funds to do things like renovations and stuff like that. And so if you're not sure where that money's going to go immediately, then sometimes offset and revolving facilities work quite well. And that's just one of those conversations that we'd have with you to make sure that we're setting you up with the right bank. If an offset facility is the right thing, then some banks offer that. All five offer revolving facilities. So yeah, just chatting through those things as well with your advisor is really important to make sure that we're not just leaving money sitting in the bank doing nothing. And yeah, and like we can restructure as you come out of a fixed term. So if you've got a home loan at the moment and you're coming out of a fixed term and you think, oh, I could actually take advantage of an offset or revolving facility, then that's one of those things that we could chat about, because we can restructure that fixed borrowing that you've got into a new type of facility to make the most of that. The other thing that isn't in here that we're doing quite a bit of at the moment is just around those renovation loans and green loans. So if you are thinking of borrowing money to renovate your house or to like do double glazing like I want to do, or other type green products like solar, EV chargers, those types of things. If you're thinking about that, there's some pretty cheap money available to do it. Pretty common thing at the moment. So yeah, have a chat to us about that. And then, as I kind of alluded to in the beginning, like please get the specific advice. Everyone's situation is quite different. Everyone's risk tolerance is quite different. And every conversation that we have with people around those things that Amber touched on around short-term fixing versus long-term fixing is a different conversation. People's risk tolerance is a lot different, and their own personal situation is a lot different. So we just want to chat that through with you before we do anything or recommend anything. So in terms of opportunity, I think at the moment there's a lot of doom and gloom. And so what we wanted to chat through was just where there is potential opportunity at the moment, because things are a little bit, they could feel a little bit flat or a little bit negative, and we just think there is some positivity out there in all of this. So the current rate environment is that rates are still, low to average historically. So when you look at rates across, 20 years, for example, the rates that we've got now are actually pretty bloody good. And so for those that are getting fixed in, and for those that are looking for a longer term, strategy, they like getting fixed in now is actually not a terrible thing. And it just provides opportunity for people to get into the market as well, while rates are a little bit lower. And if you're a first home buyer, hey, you can get in, you can fix for a decent period of time, you can have certainty, you know what your repayments are going to be while all of this stuff goes on in the background, and it's not that scary. So yeah, serviceability is still really good. And so what I mean by that is that the affordability at the banks is relatively good. So for people that are, for people that are wanting to borrow money, the serviceability side of things is pretty good. It's not that hard at the moment. The test rates, so test rate movement there, what I'm referring to is when the banks test your ability to borrow money, they use a test rate slightly higher than what the current interest rates are. So they test your ability to repay the loan at, say, 7% when rates are at 5%, to make sure that you're able to sustain an increase to a potential interest rate increase. So some of that will change over the coming months probably. Like as interest rates go up, the test rate will go up. So serviceability at the moment is still good while interest rates are relatively low, and we haven't had a lot of test rate movement. Um, and the competition, man, there's some competition at the moment. The banks are throwing some cash around, which is really nice. So yeah, maybe do you want to just chat a little bit about refinancing, Amber, because we are doing a bit of that at the moment.
Yeah, we are. We're doing a lot of refinancing and throwing that cash around. There definitely is some incentives out there to move. We're also starting to see some banks move rates quicker or slower in some cases. So those fixed rates we saw sort of earlier, that's sort of the average, or those are the best that we're seeing in those sort of 1 to 5 year rate spaces. But there are some banks that are a little bit stronger in the shorter term rates and then more expensive in the longer term rates, or vice versa. So depending on your strategy, the structure that you're after, how you want to break that down, there are some kind of opportunities with different banks to make sure that it's working for you. There are also, when it comes to that strategy stuff, so revolving, the offset, not every bank offers exactly the same thing. Certain banks offer different ways of adjusting your repayments during your fixed term as well. So yes, there's really great incentive for refinancing because you can get some cash in your pocket. You might also be chasing better interest rates, but you also might be chasing better products that are better suited to you. So it's definitely worth having that conversation if you're outside of your, like if you got cash when you purchased and you're sort of outside of that 3-year period. Often there's some really good incentives. Even if you're not, it's still worth having the conversation and going, actually, like, is this working for me? What can I do? Or is there a better option? And sometimes it's actually asking your existing bank, hey, is there anything for me now? Because that's what we call retention cash. So yeah, definitely some options out there. If your fixed rates are coming up, that's a great time to review refinancing. But it's not something that has to be done at that stage. So yeah, have that conversation at any time if you're kind of like, hey, what am I doing? There's definitely opportunity. But yeah, the main piece there, get some advice and get into it. I don't like, it's not the time to kind of sit back and wait for things to change, because as we've kind of said, rates are probably going up. With that serviceability, those test rates are probably going to go up a little bit. So it's a really great time to sort of get amongst it if you've been on the fence for a little while. Because opportunity is everywhere. I think there's plenty of properties on the market. We are seeing some really cool successes, especially with first-time buyers moving things forward, and that's always really nice to see. But yeah, plenty of opportunity. So take it while it's there.
Yeah, and I think like if you are, we've kind of spoken a lot about fixing existing loans and things like that. But if you are looking at getting into your first house, just getting approved at the moment is definitely the first step, and you've just got a massive advantage in being pre-approved going into a negotiation on a property at the moment. And the same is probably true for people that are looking to sell and buy. Just getting yourself approved and having the conversation with us about what it is you can go and do, so that you're kind of competitive with your offer going into it would be the last thing that I'd say. So I think that's pretty much all we wanted to cover off. So if anyone has got any questions, can you see the chat thing?
Yeah, I can. So we've got one. At what level should my lending be to consider splitting it? Quickly, a couple of things here. Honestly, any level, it really depends. Like Adam said, risk appetite, what your goals are, how you're going with your repayments. If you're like, I actually want to be smashing my lending off faster, I'm paying quite a lot more than the minimum. You could split a portion off so that you're focusing on kind of repaying a portion of it really quickly. Like you might actually split, it could be 20, 50 grand that you're like, I'm going to pay that off in 12 months time. So it's very much around kind of what those goals are. There's no kind of minimum amount that you need to split it off. When it comes to revolving credit or offset, anything that you're putting in there and offsetting what you're paying on your home loan is going to give you a benefit, because you could be saving that. If the equivalent is fixing for say 2 years at 4.99%, that's the interest amount that you're actually saving by having that money working for you. If you had it in a savings account, you're going to be earning a way less than what the interest is that you're paying on your mortgage. So it's kind of weighing those things up, but there's definitely benefits at any level. Yeah. There's another one that's come in. When do you expect banks to raise interest rates after each announcement? Adam, do you want to?
Yeah, there is no rhyme or reason really. Sometimes it's literally the hour after they increase them. Sometimes it's days, sometimes weeks. Um, Typically, what you see is one bank move and then the rest follow. And we haven't had that one bank move yet. So I don't think there's going to be heaps of movement before the next review, which is in September. There could be a little bit in that short-term fixed rate space, movement upwards, but if we haven't had the movement the day after the OCR, like I wouldn't expect anything major. So yeah, don't know if that really answers the question. Sorry, but it's a little bit It's just a bit random at times.
Yeah. Anyone else got anything pressing on their mind? No. That appears to be kind of it. So any last comments, Adam? Anything else you want to share?
No, not really. I think just even though some of us would have hoped for a hold in the OCR, I think the strategy from the Reserve Bank and to their credit is probably that whole short term pain, for longer term gain. And even though that may suck for some people who are already kind of like hurting, we do need to get this inflation sorted so that we can just like move on and yeah, get back into a normal economic cycle. So I think it's probably positive, like overall, that this is the direction that we're heading in, and hopefully just a signal for where things are going to be heading forward.
Mm. Cool. Yeah. I mean, knowledge is power. I think, yeah, like knowing these things or knowing where it might go, yeah, get in touch, reach out, whether that's really early. You might be like, I'm expecting it to pinch. So reach out. Or if you're actually excited and you're like, oh, I want to make changes and you're getting amped up about it or you want to borrow more, also get in touch. I think, yeah, all about opportunity and yeah, using it to our advantage right now. So thank you so much for tuning in. We have recorded this. So yeah, if you want to listen to any of it again, or if you want to have a conversation, our details are there for you now, and we will send out an email. But yeah, both Adam and myself and the rest of our advisor team and our wider team, we are all ready and waiting. Would love to have a conversation. So yeah, don't be shy, get in touch. And yeah, let's get out there and
Buy some houses.
buy some houses. Fix some lending, all of those things. But yeah, thanks so much, guys, and have a fantastic Matariki weekend.
Yeah.